Welcome, everybody, back to the Four-Star Wealth Advisors, today's Market Explained podcast. I'm Brian Castle. I'm your host. I'm here with my co-host, Mr. Christopher Reardon. Chris, welcome to the podcast.
Thanks, Brian. Good afternoon, everyone. I'm glad to talk a little bit about the markets.
Excellent. We have a special guest, a return appearance to our podcast today. His name is Jack Walsh. We call him Trader Jack. Trader Jack, welcome back to the podcast.
Thanks, Brian. So glad to be here, and we do live in very interesting times. We have so much to say today.
We sure do, and I always say that in the financial industry, there's lots of smart people, but usually the smartest people in Wall Street and Wall Street related careers are the people that understand interest rates and the bond market. There's nuances there that the stock oriented people don't really get. Everybody's a hero when your stock goes up, but to know and understand all the nuances of the bond market is really a skill, and they're the smartest people on Wall Street, and that is my friend Jack Walsh. So Trader Jack, smart guy, welcome to the podcast.
Thank you, Brian. It's goes all the way back to business school, right? It's kind of the first thing is what is Fed policy? Is money going to be easy? Is money going to be tight? And what's the effects of that easy money or tight money on asset prices? So,
excellent. Well, good. Well, we're going to cover all that. And Chris, of course, for everybody's reminder, is our four-star director of development. He's the master of all things portfolio, trading, reports. Chris still loves his Cleveland Indians. He's a caretaker of his new golden doodle puppy, Hudson. We have a new Reardon on board. We have another Reardon coming on board as well. So there's a lot growing over there in the Reardon household. So, Chris is a wonderful guy to work with. So again, welcome, Chris.
Thanks, Brian.
I'm Brian Castle, your founder, CEO, founder of Four Star. I'm an Eagle Scout, trustee of the National Boy Scout Foundation, a philanthropic advisor, an investment advisor for now 38 years. I'm also chief dad to Quinn and Evan and husband to the amazing Tripty. So, hey guys, why don't we get about it? Again, folks, if you like what you're hearing, please tell your friends and send them a copy of our podcast. And also give us a 5 out of 5. You can only really rank it on Apple iTunes, but go out there and do that. Would you? The more 5 out of 5s we get, the higher rankings we get, the more people that hear it. And it works out for us overall. So thanks for listening. Today, we're going to do our standard program, but we have the added benefit that we have Jack here with us today. We're going to talk about the markets in general. We'll talk about the economy and then general subjects about what we see out there. So Chris Reardon usually does the review of the markets. Chris, do you want to start out with where are we in positioning between the 6 major asset classes? Are commodities still in charge here?
Yep. Yes, they are. But a bit of a shakeup. We're starting to see commodities kind of pull back a little bit. So commodities lost 23 points from the last episode. It's at 290 tally points now, but still in the number 1 position. Yeah. Number 2, we had cash move up 4 points to 197. So cash is still holding strong in that number 2 position. Domestic equities surprisingly actually gained 6 points. To move to 176. So domestic equities firmed up a little bit. Fixed income overtook international equities for the 4th position. It gained 8 points. It's at 160. So really in the 3, 4, and even 5 position coming up, we kind of have a bunch of asset classes kind of bunched together there. International equities is 5th. It's at 155. It lost 3 points from the last podcast. And currencies still in last. It gained 7 points though, and it's at 112. So the biggest story I would say is the biggest loser was commodities since the last podcast. We really started to see that asset class deteriorate since the last podcast.
So commodities have been really strong. And in fact, Jack, you were involved in the nickel trade that we had here in the first half. So we made a killing in nickel, right? Do you talk a little bit about that?
Yeah, Brian. One of our portfolios, the dynamic turned positive on commodities, and we invested in nickel, and it became very much a hot topic for the newspapers and the business shows. There was one gentleman, my understanding, a Chinese producer, who had shorted really a tremendous amount of nickel, so much so that the other players in the market realized that he probably would not be able to deliver that price. So nickel shot up, doubled, overnight, and that's where we took profit on part of our position. It continued to trade up even more, and that's when the exchange stepped in. When somebody has that big of a position and it's going to threaten, whether it be a bank or the exchange, they came in and basically stopped trading, and overnight it was gonna double again. When you sell something that you can't deliver, it's called a short squeeze, and it was going to cause great pain. We had a huddle the next morning. We sold the balance of our position, and lo and behold, the exchange, JP Morgan stepped in, as a lender, and basically the exchange stopped trading and forced prices lower. I believe there's a lawsuit out there somewhere. So our relative strength investing really served us well in that instance, and we didn't know why at the beginning, but it turned out to be a very profitable trade for us.
Right. So we got the signals and we made the moves, and then sometimes you realize later why it happened. But nonetheless, it worked out really well. And there's always an element of luck. So we didn't know there was going to be a short squeeze in commodities, but it worked. And commodities in general worked, Chris, with oil and in grains, and we even had silver, a little bit of some precious metals in there. So first half was all about commodities, wasn't it?
Yeah. I mean, I think obviously a lot of it was even exacerbated by the Russian invasion of Ukraine. But commodities were very, very hot for the first quarter. I would say even the first quarter and half of the second quarter before it started to cool off. And I think a lot of that was the Fed raising rates, which strengthened the dollar, which caused certain issues abroad from the commodities perspective. And then I think right now you have a lot of fears with potential global recession coming on. So we're starting to see some of the kind of future outlooking here, and maybe a slowing in commodity demand is what the expectation is, and that's why we're seeing it cool off a little bit.
Yeah. So this is our first podcast, gentlemen, since we began the second half of 2022, beginning on July 1st. So we had the 4th of July weekend, and now we're into another week in the month, a full week. And this first half of the year in the market, which the S&P was down roughly about 20%, and the NASDAQ technology down 30 on the average, but a lot of the headline names, big time tech names, are down 40, some 50% for the first half. It turns out was the worst first half in 52 years since 1970. So everybody got really hurt in their stock portfolio unless they had some other plan. So 1970 was the last time we had a market as bad as this. And the interesting thing, though, is because interest rates were going up and the Fed is worried about inflation. Now we had the worst bond market ever, actually, in the first half. So if you had a portfolio that was invested in dividend-oriented stocks and you had an opportunity to get out of them or to hold them through that whole period of time, maybe you were down single digits, not as bad as the S&P 500. Or if you had a portfolio that got out, we had one portfolio that was down only about 3% because it went 100% cash earlier in the quarter and has been sitting there. Your bonds, which are down 10 to 12%, might have actually been down more than your stocks for the first half, which I don't think we've ever seen the bond market down in the first half more than stocks. So Jack, you're the bond and interest rate guy here. What do you make of all this? Why is the bond market down so much, and what happened?
Yeah, well, Brad, we've never really had an inflation scare. I've been at this for 35 years, and I would say what was really shocking was that 8.5 or 8.6% right before the last Fed meeting. They went to the Wall Street Journal and basically tipped their hat to the market that they were going to go 75. You and I have spoke that they should have started this process at the third or fourth quarter of last year. They were really late to the game. There was a lot of stimulus, whether it be monetary or fiscal stimulus, and they really had to get after it quick. Now, I would say that we're seeing with the strength in the dollar, inflation expectations ratchet lower quickly. I do think that this Wednesday and Thursday, the CPI and the PPI numbers are really big for the market, right? Because we could still have another shocking. Keep in mind that these numbers will be for June when gas prices we're still moving up, right? So we may get shocked tomorrow and Thursday, and then once again that brings in more speculation about a more aggressive Fed. But I would say from looking at the yield curve, Brian, they've done a really good job of getting inflation expectations lower, right? And we see that with the stronger dollar. We've seen oil go from 130 to 99, 95. We've seen mortgage rates dip from 6% to 5.50. So I am not doom and gloom. We are closer to slaying at least inflation expectations. And you can see that in the curve. The 2's10 spread is -9. It doesn't mean that it's not going to go more negative. It could be -20, -30, right? But you could tell from the newspapers and all of the business programs, the talk of recession, Jamie Dimon talking about the hurricane, pullback in bank lending, and it's just an overall adjustment of asset prices, right? This idea about a 60-40 portfolio. Well, the 40% safe bucket was your bonds, really didn't help you very much, right? So I really like our strategy, our rotation models, and this idea that when things get bad, we will go to certain percentages of cash, right? All of our investors like the idea that in retirement, they got somebody who has their back, basically. So.
Well, and let's talk about that. So in this first half, if you take a look at your statement that should be arriving in your mailbox right now or available online, if your portfolio is down big and you're really stressed out about it, and then when you watch the TV and you see a day when the market's down and it makes you really nervous and stressed out, well, then you probably have the wrong portfolio. That you need to get in a position where you're not so worried about every decline, because there might be more declines. We're not trying to be negative about the way things are, but based on the trends in the economy, it's possible that the markets go lower. We had an interim low recently about a week and a half ago, and then we've had a little bit of a rally in the market. We might have seen the bottoms, but we might not have. And history would say, we mentioned this on a previous podcast, that the likelihood is that we do go lower. We break the previous low from a week and a half ago and go lower, but we would be thrilled if that was the wrong prescription. And very often, we do not know the bottom of the market until 60 to 90 days after it happened, because we need to get evidence. And we talk about an evidence-based move. There's some videos and about commentary we made on podcasts about we're in an evidence market. We'll put money back in the market slowly as we get more and more evidence that things are better and better. So we don't flip overnight. It's not like a switch where you turn the light on or off. It's more like the dimmer switch. We dim it down, we dim it back, and we raise it back up. So we're in the process now of possibly raising it back up, but we were maximum protection as recent as about 2 weeks ago. And we've been that way for about 5 to 6 weeks before that. So we put a piece out about what will the market do. And the truth is, we don't really know. But we know what we'll do when we get different bits of evidence. So we're in the position right now where relative strength is saying the market's looking a little bit better. But history would say it probably goes lower. So time will tell, and we wait and we watch and we see what happens. And then we'll know what to do. Talking about the economy, though, Bob Barone, our economist, just recently appeared with his partner Josh Barone, the chief investment officer of Universal Value Advisors in Reno, and they're also four-star associates. And Bob said we're already in a recession. Chris and Jack, we looked at the payroll survey, was very confusing. Chris, you had some numbers on that, I believe.
Yeah, we really had two numbers that came out regarding jobs, and one showed that the U.S. economy added 372,000 workers in June. So that would, lend people to think that the job market is hot. But I believe it was the payroll survey that showed that, or the household survey, I should say, that showed a negative 370. So two very, very different numbers there. And I think that's the issue right now. Is there's a lot of numbers that are being thrown out there. Some grab headlines, some don't, but they're pointing to two very different states of the economy. Whichever one the Federal Reserve wants to pick up on, they'll pick up on and maybe raise rates more or less than expected. So that's really what's driving this right now is the expectations of what's is this hot 372,000 number going to drive the Fed to do a 75 basis point rate hike, or what are they going to lean on? So you want to add anything, Brett?
It's a weird divergence, right? So one survey's up, one survey's down. So that'll all be settled soon, but it's not a settled issue right now for sure. So that creates some risk to the economy. Jack, we talked about oil demand and it being greater than supply. I know you looked at oil. What do you say about oil today?
Yeah, I just, Bri, the commodity market is driven by supply and demand, but also expectations on the reserve currency, right? So, like I said earlier, the Fed has done a really good job of talking tough, and they backed it up with 75 basis points, right? They're going to continue to talk tough because they want to drive down inflation expectations, right? Oil prices adjusting from 130 to 90, 95, 99. I mean, I think that's great. The problem that I see is I don't see the country having an oil policy that really is going to keep prices lower. The talk now is that Biden is going over to Saudi Arabia, basically trying to get them to pump more oil, right? So, for the time being, we have a lot of speculative longs getting forced out of the market on this corrective move. I think it's very dollar dominated. As I was saying earlier, we have big inflation numbers Wednesday and Thursday, CPI and PPI, and I think that these numbers could still shock on the high side. So it's a very fluid situation. The Fed's going to continue to talk tough because they don't want inflation expectations to pop on them. But also, people like Josh have been warning about, cracks in the financial markets, whether it be spreads blowing out, high yield, things of that nature. So there's already an expectation in the futures market that early next year that the Fed will be cutting rates, right? So the Fed is walking a very fine line here. They want to continue to squash inflation expectations, but not only are they the central banker for the U.S., they are the central banker for the world, right? And we know about currency problems, with the euro being close to parity, and so they better be careful.
Yes. Well, and then back to your discussion about oil, there's greater demand now than there is supply. And because of the moves of the administration, while they are saying that they will do anything they can to get oil prices down, they're limiting drilling. They cut off pipelines. So they're really saying one thing and doing another. So the oil companies have said, hey, we're not going to invest in new wells and try to drill here, even though they have leases, because the administration is attacking them at every turn. So they've canceled billions of capital expenditures. There's no incentive to invest in a 3 to 5 year timeline, but yet the White House is aggressively pushing them to do that, but they're never going to do that. And unfortunately, Germany and many countries in Europe are in trouble because they let themselves become dependent on Russian oil, and Russia is now cutting off Europe. Germany recently fired up coal plants, which is exactly the opposite of what the green folks want to happen. But they really have no choice because they need energy. China, that claims to be in with us on long-term climate issues, they're building 19 coal plants, which is exactly the opposite of what all the folks who are climate people want, costing over $1 billion each. And even with all the attempts over the last decade or so to convert everything to electric and renewables, really only 10% of the energy in the world is in any form of renewable, and solar, wind, and it's much more expensive than oil and coal, and it's not even available in the third world. So everyone wants to be energy, clean energy. Everyone wants the environment to be well taken care of, and leading to cleaner energy sources is great, but we're just not there yet as a world, and certainly as a country. We're seeing that now with gas prices exploding. Germany just got shut off from natural gas and oil, so they're in really big trouble. There could be gas lines. There could be riots in Europe. I mean, who knows what's going to happen there with this war over in Europe? So it's a little crazy. Chris, I know you've looked a little bit at that as well.
Yeah, I mean, I think that the other big key in the U.S. is, even if, per se, this administration wanted to incentivize them to start drilling right now, the big bottleneck, and I believe we spoke about this on the last podcast, is the refinery shortage here. Even if they produce another 2 million barrels a day, we can't refine it any quicker. I think refineries that are all at 100% capacity in the U.S., so it really doesn't do us any good besides bringing more oil and just putting it on a line, waiting to be refined into actual gasoline. So, I think there's no quick and easy way for us to really undo, past mistakes, I guess, of this administration that's put us in this position. And, I think, and I've mentioned this on here before, I think, what we need moving forward, if we're going to continue, and I think the world wants to a degree, down this road of, towards renewables, towards that, is we need a long-term plan that stretches 50 to 100 years, that transitions us slowly and responsibly, not a 5-year plan or a 2-year plan to try to restrict people, because all that's going to do is cause extremely high prices and really cause what we're seeing Germany do is a slingshot right back into having to fire up coal plants or do other irrational things because there's out of necessity. So I think that we need a responsible way to move forward, not this irresponsible way of throwing out deadlines that make no sense.
We've heard discussions from Brian Deese, White House economic advisor, of a new liberal world order. This is, I think, what they mean. Something like that. So we'll see. Well, and so the inflation that's being caused by gas and food is causing everything to slow down, like retail is slowing down. Bob Barone mentioned this in the recent discussion. Look at the stocks of Target, Restoration Hardware, Bed Bath & Beyond, the XRT, which is the retail ETF, Estee Lauder, some of the cosmetics companies. All those are down. The food costs are up, so prices are up at Costco and Kroger. So it's really causing a lot of havoc with this inflation. Although in the short run, gas prices have decreased every day just a small amount for the last 21 days, according to AAA. So maybe inflation will go away at some point, but the White House is suffering, certainly in image around the world, in the country, and around our allies around the world, and initially started blaming COVID for the inflation blame game. And there was probably some truth to that with the supply chains, all bollock stuff. And and whatnot. But then we were blaming Putin and the war. Then the White House blamed the other party. Then they blamed the oil companies that they weren't drilling enough. Then they blamed the livestock ranchers who are keeping the livestock prices higher when they supposedly didn't need to. Then recently they were attacking gas station owners last week to lower the price of gas. Now, we all know that gas station owners don't really make money on gas. So while you go to the gas station, you fill up your tank and you go inside and you buy all the candy and all the other stuff that's in there, and that's where they make all their money. So that's what we should be focusing on. We should be along all those things and owning all the things that are inside a gas station, not the gas itself, because they don't make any money on gas, really.
Well, that reminds me of our trip in March, Brian, when we had to charge up the Tesla, and we spent a good 55 minutes there, and I know there was at least one trip into the station to get something to munch on.
Yes,
but it goes back to productivity and how quickly we're going to be forced to take on EVs and policy. There's sensible policy and so.
Well, and some of the governors, Jack, have suspended or eliminated their gas taxes, and that's fine for the short run. But those gas taxes pay for our roads, and if we don't put those gas taxes back on, we're probably going to have bad roads in a year or two, because that's how they keep up all the roads. And we've had an infrastructure problem in America for a while, and the administration did pass an infrastructure bill, so they're building bridges and big facilities and things that have been in disrepair. But we can't get rid of gas taxes forever because of the roads. So it's quite interesting how things are playing out. So anyway, talking about the job market, basically an assessment of the job market since COVID, there were 22 million people that were put out of work, and we forcibly closed about 40% of our economy because of COVID. So everyone was scared. We didn't know what to do. That was the mood at the time. And so that all happened. The reality, though, is that 5 million people never went back to work. The U3 unemployment, which is the unemployment rate that we hear, is still at record lows. But that's really because people didn't go back to work. But if all those people are not working, then how is that measured? And I just want to share with everybody how that is measured. There's a number called the labor force participation rate. And that says, okay, how many people are actually in the labor force? When they ask you the question, are you working now? Are you trying to find a job? Then you ask all those questions. A lot of people are saying, no, I'm not trying to find a job. 5 million of those 22 million people never went back to work. So labor force participation rate is now at record lows since they started calculating that number about 50 years ago. So the reality is a lot of people got used to their payments are all gone. The COVID payments are most of them. But there are people that just like not working, and maybe they retired early or something, but they're not there. So there's a huge labor shortage in America, which we've been talking about. That there's a lot of implications to that, guys. Chris.
Yeah, I mean, I would say, what we're seeing as well is a transition in the labor force too. I mean, for the last 5 years, a lot of it's been tech hiring and tech expanding, tech-related companies, on these big hiring sprees. Well, when COVID hit, and then kind of post-COVID now, you see tech companies are starting to kind of let people go, rescind offers. We're seeing a lot of that. And you have a lot of leisure, service industries, travel industries. You have a lot of these industries that are sectors that are struggling to find workers. So you have like an overabundance of workers, oversupply in the tech, and you have an undersupply of people willing and wanting to, be airline pilots, to be servers at restaurants, and it's causing a lot of havoc, travel this summer. You have this major increase of demand. There's just been this huge pent up and really backlog of people wanting to travel and go to Europe and go to, nice vacations and weddings and all that stuff. So all that's brought to the front. So demand is there, but supply, and particularly employee supply, is at all-time lows. So, we've had issues where London Heathrow announced this week it was going to cap departing passengers to 100,000 a day in an effort to try to curb long lines and delays with understaffing and security concerns. So, really unprecedented things are happening from the, travel front as they try to maintain this. I think everyone's heard about flight delays, flight cancellation. It's been almost a nightmare to really try to travel via airline lately.
Yeah, and Jack, you mentioned the other day about a restaurant you went to that closed early.
Yeah, it was just my son and I. We just wanted to go in and get a hamburger, and we walked in, and they said the kitchen closed at 5, which we were shocked at. And he said we can't get enough cooks. He's like, we need a couple more cooks. And I wasn't surprised because we've seen that in the papers that there's certain industries, restaurant industries, that can't get servers, they can't get cooks. So I think that goes, Brian, to what you were saying about the millions of people that were laid off. They were given incentives to not really work, and now that we're trying to get things back to normal, there's not enough willing workers right now.
Well, and we've always had a system of backstopping folks in America, at least in the last 70 years. The program, commonly known as welfare, where people get paid when they're unemployed for 26 weeks, and that's usually about the rate of about $20,000 a year. So it's certainly poverty level income, not an income. The average income is about $54,000 a year. So at $20,000, it's hard to raise a family on that, but at least you pay a bill or two. But the incentives go back to work, and then sometimes the politicians, very often around election time, will extend that 26 weeks to 99 weeks, and they're being compassionate and this and that, but it's probably more about elections than anything else. But then that goes away, right? And in fact, President Bill Clinton passed some of the welfare to work legislation, although during the Obama administration, they loosened some of those rules, so people can be on welfare a little bit longer than had been in the past. But now the latest trend, since people got so used to getting payments from the government, is the universal basic income, right, guys? It's about $500 a month from Cook County, Illinois, Jack, right?
That's what I heard, Bri. And boy, that's a concept that's been around for 10 or 15 years, and I think it started in Europe. But it's the consequence of COVID and what people are getting used to, this idea of just because people are living, them getting money to survive. I'm very compassionate, right? But I'm more about, let's get these people into a restaurant. Let's get them into a training program. We've hired people. You want to see a background of somebody who's trained themselves or went out and got training. You want to see ambition. So this idea about universal basic income, I think it rubs a lot of people the wrong way.
Yeah. Well, and the politicians put that in Chicago and then some other cities as well, but they also could take it away. So it's not a forever thing, but some would like it to be a forever thing. But clearly a lot of people developed habits where they got used to just getting payments. I think the only qualification, Jack, is that you be alive, right?
Right.
Be alive.
That's the idea behind universal basic income. It is.
Pulse and see if then you get income, right? So usually it's you have to work, right, Chris? I mean, come on already.
I think the one important thing to note as well is, even if we did adopt a universal basic income, Maybe in the short term it would impact, but long term prices will just adjust to that being a floor. So it'd have to be something similar to, and we see it in Social Security to a degree, right? Is it's got to constantly be increasing. So once we put that in, it's only going to continue to be a drain. And I think if we were to go down that route, it would just cause more issues and would solve very, very little problems in actuality.
Right, exactly. Well, and during the pandemic, as we developed all these habits, it's real clear that our enemies are watching us. China's getting very, very aggressive. Russia's been lots of rhetoric. Of course, Iran is always after America. So all our enemies are watching us getting weaker and weaker, and we're making payments to people to do nothing. And so, all these trends are probably not a great idea for the world's largest power to be a powerful nation. So we'll see how that all develops. But the incentives, always had incentives for people to work. Those that should work, and they can certainly gives them a reason to get out of bed in the morning as well. And we talk about this too, that if people have a reason to get out of the bed in the morning, they probably will. But if they don't really have a reason to get out of the bed in the morning and they know they're getting a payment, they just might not, right? And that's the incentive that we're creating with this stuff. So hopefully it changes. But the states and cities that are doing this, the big welfare states, the New Yorks and the Californias and now Illinois, are losing companies, right? And we've seen a bunch of that recently, guys, haven't we?
Yep. Yeah, I think I know one Caterpillar recently, which was in Chicago, moved theirs to Texas. It was one notable one.
Yeah, and Jack lost them to Miami too.
Yeah, Ken Griffin, right? The big Citadel. It's a Chicago always has been a big financial hub. Going back to the exchanges, the CME and the Board of Trade, and Ken Griffin is really an icon in the industry. Is taking Citadel from Chicago and he's moving it to Miami. What a shame.
What a shame. So the big cities who are adopting a lot of woke policies are struggling. They're not doing as well as they used to. People are not back in the offices yet. It will eventually change, but it's going to take a while. And then also we heard recently that the military, there are 40,000 military National Guardsmen are being released from their posts because they didn't want to get vaccines. So now the science, everyone realizes, doesn't support that anymore. But yet there are certain parts of our government that are still doing those things. So those people are leaving their jobs because they don't want to get vaccines. And usually the people that are in the military are some of the last people to want to take a vaccine. They're usually in very great shape. They probably don't need a vaccine. They're the kind of people who are, really very independent, very headstrong types who don't really want to take a vaccine, but yet they're being forced to. And if they don't, they're being released. So we still have a lot of strange policies in this country that are pandemic related, and hopefully we can make changes and turn that stuff around. But the good news is about the theaters, Chris, right? There's some good news, a lot happening with the theaters.
Yeah. I think Maverick, the Tom Cruise movie, topped $1 billion. I think it was his first $1 billion movie. So, I think, once again, I'll put my hand up. I went and saw it, and I thought it was great. I know a lot of people, that was the first movie that I went back to the theaters, I think, since probably 2020 or 2019. It's been a while. So I think we're starting to see people kind of ease back in, and we're starting to see movies kind of move back towards the theaters after being on video on demand and on certain streaming platforms for a while, which is great to see.
Yeah. Now, Chris, you mentioned something about some images in space, and you had a number of things in what we see out there.
Actually, I think it's today. So this is July 12th. The first full color image from the NASA's James Webb Space Telescope came out, and it offers really cool. It's the highest resolution and the deepest infrared picture we've ever seen of the universe. So really kind of a cool picture to see. You see a lot of galaxies, a lot of really space out there. So I thought that was kind of cool to see. I mean, I know we're always, that's kind of the biggest frontier. We have SpaceX. You have a lot of kind of things going on that front. So that was very cool to see. The other thing is Texas is asking some of their residents this week, so once again, July 11th, week of July 11th, to conserve power as the Texas power grid is going to get stressed immensely. Temperatures in Texas are supposed to reach around 112 degrees, I think, all week. And they're afraid that with air conditioning units running, all that stuff, it's going to overwhelm the grid and cause rolling blackouts. Last time we really saw this was on the flip side during the snowstorm that hit Texas, and you had people running heaters and a lot of warming there. Go, Brian.
No, excellent. And then there's new information on the Elon Musk and Twitter scenario as well.
Yeah. So Elon Musk decided on, I believe it was Friday officially, to call off his purchase of Twitter to take it private. The main crux of it stemmed over Twitter bot accounts, and Twitter wasn't willing to reveal or didn't have. I think most of it is that they didn't even have factual data or a factual way of discovering all the bot accounts. After he called it off, I believe earlier this week, Twitter plans on suing Elon to force him to go through with the deal. One thing to note, so Elon's original purchase price was $54.20 a share. Twitter currently is trading at about $32.50 a share, so a huge drop off from what it was, the initial purchase price was. And one last thing I'll note there is there's speculation that Elon could be playing this game, A, to get information in regard to the bots if there is, and B, to possibly get a lower price. When Elon did the first bid for the company, he did it through margining his Tesla stock, and Tesla has gotten battered like a lot of tech stocks with the recent pullback. So since then, he's pivoted to going to more private financing, going to other investors. And that's even got more expensive now with rates going up. So it'll be interesting to see how it plays out. It's certainly going to be a long legal battle. I think at minimum, it's going to cost probably Elon Musk, if it does break apart, $1 billion at minimum.
Yeah, and then since Twitter is going to sue Elon Musk, they're required to show in discovery the information they wouldn't show him prior to discovery about those bots, right?
Yeah, if they even have that information. I mean, there's also speculation that they have really no credible way of actually finding out the amount of bots on their platform, because it's not really an easy thing to get to, right? I mean, how can you tell if it's a bot or if it's just some Joe Schmo who doesn't really use his account and only posted one time in 2012 and hasn't posted since, or it's a hard thing to get to. So it'll be interesting to see how it plays out. And that could be part of Twitter's defense is here's our best credible resource. And, it'll be interesting. There's a lot of moving parts to it.
It certainly is. Well, and Chris, you also noted, I think, that the gaming stocks collapsed recently.
Yeah, the last thing I'll note is the gaming stocks got hit pretty hard yesterday. I think they're rebounding a little today, down as much as 8 to 10%. And this came as news came out from Macau that they're shutting down Macau in an attempt to tamp down COVID-19 outbreak. I think they're shutting down all non-necessary operational functions within the city for a week to see if they can kind of quell the COVID-19 outbreak going on there now. So we're seeing a little bit of a slump in gaming stocks as of now as a response to that.
So we're going back to lockdowns in China and Macau, right? Isn't that amazing?
Correct. That is correct.
Okay, well, a lot of strange things going on right now, still COVID related. Now, Jack, we talked about how there's still not a lot of car inventory. You went to a car dealer the other day. How many cars were in the lot?
Just 3, Bri. And I went to see the sales manager. Now I was fortunate. I've leased my cars, but I was curious. I'm like, when are you guys going to get more cars? And they talk about the auto companies. I was in a Honda dealer. They're building a higher margin cars, right? And people are buying them from the boats, right? They'll say, "Hey, listen, I've got this for sale." And if you only have 3 cars on the lot, I do think it creates anxiety. But he also said that he didn't think that the old way was coming back. You could blame it on chips. You could blame it on whatever you'd like, right? But this idea of walking into the dealer and getting a special price on a car, because at that point in time he said they used to have 300 cars on a lot. Now they had 3. So you could see where you're kind of caught in this bind of buying their higher margin car that's being shipped.
Exactly. Well, and I have a good friend who's one of the larger car dealers in Chicagoland, the McGrath Auto Group. And for every car they sell, my friend Mike McGrath says they can sell 20 cars. And if they could just get them, they just can't get them. They're not around. So we still have a supply chain problem for cars. Hopefully by the fall and into next year, some of that is settled, but it's still not settled as of now. So we're still seeing some effects from that. So anyway, we're seeing a lot of really strange things going on still as we come out of this pandemic and we get into a normal economy. Now the economy seems to be in recession because of all these other reasons and other things going on. But have no fear. The markets will bottom at some point. Like we mentioned earlier, if you are stressed out and nervous every day about your portfolio, anytime you see the market down 3% or something, or 1%, and you're stressed out, worried about what your account value is going to be, you probably have the wrong mix in your portfolio, and we need to make changes. And we're happy to help you and discuss how to reorganize things. And we've designed a protection program that has done reasonably well here. We've got some portfolios that were down very, very limited, and also one portfolio that was up in the first half, and not down because it had a lot of commodities. So there are things to do, and there are ways to design your investing so you don't catch this much of the downside. You can give up 50% of your portfolio in a year, and it will take you almost a decade to make that back. So we're here to try to avoid that big down move. And so thanks to my colleagues here, Chris Reardon and Jack Walsh, talking about the economy and the markets and what's happening, and what things we'll see going forward. We might see the markets go a little bit lower. We might have bottomed. We're completely unsure on that. So we'll keep watching and waiting what evidence we get. But everybody put yourself in a position where you're not stressed out every day, where you can enjoy your life and enjoy your kids and enjoy what's going on in America. America is coming back. We're having some regrowing pains with all these odd things we've talked about here in today's episode, but hopefully we'll work all that out. The American ingenuity will succeed, and we're pro-America, and we're pro-capitalism, and we think things will work out. America is still the leader in the world, and we believe it will continue to be the leader in the world. So, guys, what do you say we leave it there?
Good.
Brian, thanks so much for having me on. I enjoyed it.
Thanks, Jack. So for everybody, for Jack Walsh, Trader Jack here, who joined us today, and my regular colleague, Chris Reardon, the co-host and director of development at 4-Star, and our great 4-Star team, Laura, Karen, Kamal, Tucker, Brian, we got Tom, we got Mitch, we've got Fred, and all the 4-Star advisors, and everyone that has a 4-Star account knows their advisors, or there's so many of them to mention. We'll sign off here till the next episode of the podcast. Thanks for being with us, everybody. Don't forget, give us a 5 out of 5. That would really help us. And we look forward to giving you more information later on. We'll be back with some other really great interviews with different players in the economic system. We're looking at restaurants. We're looking at a bunch of other subjects to talk about. So we'll be back with those later on. Thanks for being with us, everybody. And let's make it a great day.
Thanks, Brian. Bye-bye.